We've talked previously about accounting for leases and how one of the first things we have to do is determine whether or not a lease is a finance lease or an operating lease, and we have different accounting rules for those two different types of leases. Here I'd like to walk through a couple of examples with you to clarify how those rules work and what the terminology means. In this example, we'll be doing accounting for Holt Bookstore. They decide that they need a delivery van, so on January 1st of year one, they go to an automobile dealer, and at that dealership they find a van that the dealer would sell for $40,000. Holt decides that they don't want to buy the van. Instead, they want to do a leasing arrangement. So they want to lease that van for 4 years. And they make an agreement with the dealer that they're going to make 4 payments, 4 annual payments, and they'll make those payments at the end of each year. At the end of the 4 years, the van gets returned to the dealer. The van only has an estimated useful life of 4 years, so the dealer estimates that when they get that van back from Holt, it won't be worth very much. The resale value will be negligible. The last piece of information that we need to know here is that the dealer needs to earn a 6% return on this lease. So I'd like you to consider a couple of things here. What would be the annual lease payment that Holt Bookstore would need to make to the dealer? What would be the payment that would be the right amount to pay for this $40,000 van and provide the dealer with 6% annual interest? The second thing I'd like you to answer before you go forward with this video and see my solution is make a determination as to whether you think this is a finance lease or an operating lease for Holt. Once you've had a chance to try to answer both of those questions, come back to the video. Alright, well, let's take a look at answers to those two questions together. Hopefully you had a chance to do this on your own previously. As you recall from our time value of money examples earlier in the course, when you're trying to determine an annuity amount, what's the periodic payment, you take the value that you know and divide it by the factor for that value. So in this case, we know that the present value of all of those future lease payments has to be $40,000. So we know the present value of the annuity amount, 40 grand. To get the annuity amount, we have to divide that by the present value of an annuity factor for 4 years, 6%. If you go to your table, it turns out to be this number. So just doing the math, we come up with an annual lease payment of $11,544. If Holt makes 4 payments of that amount at the end of each year, the dealer will get their $40,000 back and have interest at 6% compounded annually. Alright, let's take a look at the second question here, and hopefully you came up with the same answer I did. This would indeed be a finance lease for Holt, the lessee in this case. There wasn't any transfer of ownership to Holt. Holt was not offered any sort of bargain purchase option, so those criteria were not met. However, these two criteria were met. And remember, you only have to have one of these criteria be in place before a lease would be classified as a finance lease. In this case, the lease term was 4 years and the economic life of the van was 4 years. So the lease term was more than 75% of the estimated useful life of the asset. Unless I would tell you otherwise, you want to assume that the lease term is non-cancelable. We also meet this criteria. The present value of those lease payments is 100% of the fair value of the asset, so certainly that's more than 90%. Well, the next thing we need to do is build an amortization schedule that reflects how much of each one of those lease payments is going to be considered interest expense or principal reduction of the lease liability. So basically, this lease amortization schedule is really similar to any loan amortization schedule. It's set up the same exact way. So in our case, the lease liability starts out at $40,000. That's the present value of all of those future lease payments. Payment 1 is made at the end of year 1. If you take 6% times 40,000, you get the interest portion of this payment, $2,400. 11,544 was paid, of which 2,400 was interest expense. So the rest of that payment goes against the principal amount of the lease loan or lease liability. So 11,544 minus 2,400 gives us the 9,144 reduction to this principal amount. So 40,000 minus 9,144 means that at the end of year 1, the lease will show up on the balance sheet for Holt Bookstore at $30,856. You can do the same math all the way down through this schedule. $30,856 times 6% gives us interest for year 2. Any amount of the payment that wasn't interest instead reduces the principal amount of the loan. So at the end of year 2, the lease liability is $38.56 minus $96.92, or $21,164. $21,164 times 6% gives us interest for year 3. You can follow that all the way through, and you can see at the end of year 4, those 4 payments of $11,544 will have fully paid off this loan and provided 6% interest for the auto dealer. Now let's discuss the accounting for this financing lease. If there were not special leasing rules, Holt would simply be deducting their lease payment of $11,544 per year as lease expense in each year as they made that payment. So they'd have a total of $46,176 of lease expense over a 4-year period. Instead of that simple accounting, Holt will instead record a right-of-use asset and a lease liability equal to the present value of those lease payments. The lease payments totaled $46,176. The present value of those payments was $40,000, as you recall. Then, after they make that initial entry to record the asset and the liability, in each year they'll record interest expense and a reduction to the lease liability according to the amortization schedule that we just looked at, and each year they will also record straight-line amortization expense of the right-of-use asset. At the end of 4 years, the lease liability and the right-of-use asset will be 0. Note that basically what we're seeing here is that the effect of this accounting is to reflect the transaction as if Holt had actually purchased the van with a loan and made annual loan payments on that van, and along the way been depreciating the van. So really we're accounting for this transaction as if Holt had purchased the van instead of leased it, and really that reflects the underlying substance of this transaction. Alright, here's what the transaction analysis would actually look like. At the beginning of year 1, they would debit the right-of-use asset $40,000, increase the asset $40,000, and increase a liability $40,000 as well. So that's the present value of all of those lease payments. Then at the end of year 1, they make their $11,544 annual payment. That payment gets broken up such that we recognize $2,400 of interest expense, and we reduce the lease liability by $9,144. The next thing we have to do in each year is amortize the right-of-use asset. We do this on a straight line basis. So $40,000 asset divided by 4 years useful life will reduce this asset by $10,000 per year. So we reduce the asset by 10 grand and we record 10 grand of amortization expense. Notice that total expense related to this lease in year 1 is $12,400. We do a similar thing in year 2. In year 2, interest expense, these two numbers come straight from the amortization schedule. Interest expense is less than it was in year 1 because we had a lower loan amount to pay interest on. So interest expense is $1,852. The lease liability goes down by $96.92 in year 2. The amortization of the right-of-use asset, this is amortizing this asset up here. The amortization of that right-of-use asset is $10,000 again. So total expense related to the lease is $11,852 in year 2. We do the same kind of thing in year 3 and year 4. In total, if you add up all of the interest expense and all of the amortization expense, it adds up to $46,176. So it adds up to the total amount of the lease payments. What you want to notice, though, is that we're not taking deductions on the income statement at $11,544 each year. Instead, we take higher deductions in the early years of the leased assets life and lower deductions in the later years. So we've front-loaded expense in the early years when we have a finance lease, really because we want it to represent what would have been recorded as expenses if this had been a purchase, because we feel like the underlying substance of this transaction was indeed a purchase. The balance sheet also reflects that underlying structure of the arrangement, that the substance of it being more like a purchase than a lease. All right, well, let's contrast this with another bookstore lease example. So this time we'll have Barron Bookstore, and they're also looking to acquire a delivery van. And in fact, they're interested in the same kind of van, that van that sells for $40,000 normally. Barron only needs the van for 2 years. The dealer tells Barron that the lease payments will be $11,544 per year. The van needs to be returned to the dealer after 2 years, and the dealer's estimating that at that point the resale value of the van will probably be about $21,000. However, Barron is not required to make any guarantee about the residual value of the van, and we'll assume once again that this van has a 4-year useful life. So what do you think in this case? Is this a finance lease or an operating lease? This time around, we'd be looking at an operating lease. There was no transfer of ownership, no bargain purchase. The lease term is only 50% of the 4-year estimated life of the asset, and the present value of those payments is less than 90% of the fair value of the asset. In this case, we do not have to include the residual value of the asset that gets returned to the lessor as one of our lease payments. When you have guaranteed residuals, things can get complicated, and that might have to be considered, but those rules are certainly beyond our scope. In this simple situation, the present value of the lease payments would just be the present value of these 2 payments of $11,544 each, and that's certainly less than the $40,000 value of the leased asset. As a result, we haven't met any of the criteria. We definitely have an operating lease. Let's talk about accounting for this situation for Barron Bookstore. Again, if we didn't have any special leasing rules, Barron would simply deduct that $11,544 as lease expense each year as it made the payment. More importantly, though, there wouldn't be anything recorded on the balance sheet, neither an asset nor a liability, despite the fact that Barron Bookstore definitely has an obligation to make these lease payments. Here's how Barron will actually do the accounting for this lease arrangement. They will record a right-of-use asset and a lease liability equal to the present value of these 2 annual lease payments. The present value of these 2 payments, we'll see in a moment or two, turns out to be $21,164. Then each year, they'll record interest expense and a reduction to the lease liability according to a loan amortization schedule that we'll prepare together in a couple of minutes. In addition, each year, Barron will record amortization of that right-of-use asset. Instead of using a straight-line method to amortize the right-of-use asset, Barron will record enough amortization expense such that if you add up the interest expense and this amortization expense, you'll get a number equal to the annual lease payment of $11,544. So basically, when there's an operating lease, we don't make a large change to the income statement. The total expense in each year is still going to be $11,544. We haven't front-loaded any of our expenses. The big change when you have an operating lease is the balance sheet presentation. We need to put that right-of-use asset and that lease liability on the balance sheet. All right, well, let's look at the numbers. To get the present value of those lease payments, we just multiply the $11,544 times the present value of an annuity factor, and that's where the $21,164 came from. We can prove that answer with our amortization schedule, and it works just like the last one. The original lease liability is $21,164. That first payment would include interest, 6% times $21,164. And the amortization schedule works the same way all the way through. Here we'll take a look at how Barron would actually be recording this leasing transaction. At the beginning of year one, they'd set up their right-of-use asset and the lease liability at that present value of their lease payments, $21,164. At the end of year one, when they make their lease payment, cash goes down. We record the amount of interest expense that you saw on our loan or lease liability amortization schedule, and reduce the lease liability account by the amount of the payment that wasn't interest expense. So these two numbers come straight off of the amortization schedule, just like they did when we did a finance lease example. What's different here is how we compute amortization expense of the right-of-use asset. We don't just take this number and divide it by 2. We're not doing straight line amortization. Instead, we figure out how much would amortization have to be such that these two numbers combined would be equal to the $11,544 lease expense represented by the amount of our payment. So our amortization expense has to be $10,274 for these two things to add up to $11,544. So that will be the amount by which we reduce the right-of-use asset. Notice that in a simple situation where all of the lease payments are equal amounts, the amortization of the right-of-use asset will be equal to the amount by which you reduced the lease liability. So that'll be true in our simple examples. That would not always be true in the real world if lease payments were not all exactly equal. We see the same thing happen in year 2. We record $654 of interest expense and reduce our lease liability by $10,890. These numbers again come straight off the loan amortization schedule. And then amortization expense is basically a plug such that these two things add up to $11,544, and the amount of amortization expense that we record determines the amount by which we reduce our right-of-use asset. At the end of 2 years, the right-of-use asset is 0, the lease liability is 0. Notice that what we've recorded as lease expense is as simple as possible. It's just the $11,544 per year. Okay, so when there's an operating lease, we don't try to front load that expense amount. However, the accounting has an important difference to just ignoring the fact that we had a commitment under this lease obligation. So with our new rules for operating leases, we did have to show on our balance sheet the right-of-use asset and the lease liability. At the end of year 1 for Barron Bookstore, the right-of-use asset would be $10,890. It'd be the $21,164 minus the $10,274, and the lease liability would be that same amount. At the end of year 2, of course, both the asset and the lease liability are 0. All right, well, that was an example that I hope helped explain the accounting for finance leases and operating leases. One last note here, and that is I referred early on to an exception to the need for every single lease to be reflected on the balance sheet of a company. Our exception is only valid when a lease has a very short term period. So if a lease is less than 12 months and there's no purchase option with that lease, a lessee can use a shortcut method and simply report the payments as their periodic lease expense, and they do not have to compute a right-of-use asset and a lease liability to put on their balance sheet. So a very, very limited exception to the leasing rules that we just discussed.